and we'll just get the presentation set up till other people are joining in. I hope people are able to join in, because apologies for the delayed start. There were some teething issues. Okay, yeah, I can see quite a few names here. Fine, great. Thank you, everybody. Once again, welcome to the Stylus Virtual Connect. We missed the month of August, but then I would say the whole of July and August have been quite eventful, especially the happenings of the last, I would say, 3 weeks. I will, this time we are kind of changing the format a little bit. So I intend to talk a bit about macros as well before diving in specifically into the company specific and sector specific updates that we would like to share. There is one more announcement I wanted to make today is we over the last 3 months, we have met quite a few of our investors. And one feedback that we got was probably if we could now start a newsletter where we give updates on some of the stocks that we are currently recommending. So what we have decided is we are not going for a full-fledged newsletter, but we'll start with a pilot I think preferably from month end this month. So it will be a monthly newsletter where we will pick up few stocks which we feel where there is a update to be shared with investors, whether it is related to share price performance, sectoral performance, or company specific performance as well in broader detail. Maybe make it little infographic. That is something we feel that probably help you as investors as well to be better aware of what's happening with the stocks in your portfolio. So that suggestion has been well taken, and we'll be implementing it from this month. So every end of the month, we will be doing this newsletter for it will not only be based on what stocks we have on our model portfolio, but it will also sometimes include some of the stocks which we see are common across most of our investors. So there are, as we analyze all of your portfolios, we recognize that there are some stocks which, even though we have not recommended to you as advisors, but most of you are holding those companies. So our plan is to probably include those companies as well and give you an update of what we think on those companies at the current time. Please note there will be no price target and those things discussed, but probably kind of just share an update on what's happening with the business or the stock price. So that is one major announcement that I wanted to make. Secondly, the monthly webinar that we used to do, we are now going to shift that to a bi-monthly, once in 2 months webinar. That is, I'm not sure it's called bi-monthly. Bi-monthly will be twice a month, but we'll be basically doing it in every 2 months. We'll be having a webinar. So like this time we have in the month of September. Next we will have in the month of November. What this also does is because we will be anyway sharing a lot of information via the newsletter. So we thought that it will be much more convenient to have a 2-month slot rather than a monthly slot. The third aspect is we have seen in the last few months a consistent decline in investor interest about their portfolio. So that was something that we were thinking that it is because of the market, but we also realized that some of you investors are expecting us to come forward and give you the update. So like I said, for the investors who wanted us to come forward and give the updates, we are now going to have 2 formats: the newsletter, which is a written format, and the 2 months once we will be doing a webinar where we can discuss stocks on virtual basis. Apart from this, we are doing a couple of other things. So one is we will be starting a blog kind of a model, which will be on Substack. The data about that will also be shared to you over the course of this month. What we'll be doing in the blog is we will be sharing, probably whatever we are reading in the markets, which we feel could be interesting for you as investors also to be aware of. That is the third thing that one of the other announcements that we wanted to make. Let's now probably just dive into the presentation as well. Okay, so coming back to the market view, there is like last 2 months. I'll try to address as much as possible the last 2 months, but specifically there will be a lot of commentary about the last 3 weeks. So coming to the last 2 months, market has largely been buoyant, as you can see from the chart as well, flattish that way. But there are sudden spots where suddenly the markets are up, say 2-3% in the span of 2-3 days, and then once again the market is flattish, maybe gradually coming down. So that is the buoyancy there in the market. What this has led to is limiting investable opportunity. This is something that we have been talking the last 3-4 months as well, that we have been unable to find as much investable opportunities from a medium to a longer term perspective. We continue to maintain that 2025 will be a flattish year, as has been the case till now. In fact, if we think of say exactly from June till now, markets are absolutely flat. There is zero returns given by delivered by the market. Next, just talking on the sentiments. So obviously, this is what is driving the buoyancy in the market, that the bullishness is rampant. So obviously, there are good things happening. The income tax rates were lowered for this current financial year. Then the RBI announced rate cuts from June, which was a surprise again. And finally, most unexpectedly, the GST Council has come up. During the August Independence Day speech, one announcement was made by Modi ji. There was an expectation that this may happen somewhere around or after Diwali, but this happening in a much shorter time. In fact, the implementation happens on September 22nd itself, which happens to be the Navratri day as well. Kind of start of Navratri as well. Kind of sounds that the government is really aggressive in how they want to propel the economy forward. See, there has been a clear dip in performance of the economy. Okay, ignoring the GDP growth for the time being, let's just hope the listed top 500 companies, which is also our benchmark, has performed. The profit growth for the 3-month quarter from April to June, YOY, so April to June 2024 versus April to June 2025, the growth in profit was just 4%. And this 4% also, mind you, was driven by a lot of commodity stocks. If you exclude the improvement in commodity prices and some one-time gains, etc., the performance was actually negative. There's no clear number on that, but ballpark we estimate earnings would have declined somewhere around 2-3% YOY. Now this is a staggering, it really triggers us to think, what are we doing in the markets? Just to kind of complement this information, I would like to share what happened for the Jan to March quarter. Now the Jan to March quarter happened from April. So there was a very big jump in exports that we saw. Many companies reported very strong quarterly numbers. Almost, I would say that Nifty 500 was 8% in the same period. I'm talking about the profit. But I would say again, that was largely being driven by, pull forward of sales. So because tariffs or import duties, etc., were about to come, lot of companies decided to export their goods in advance, have that inventory sitting in US directly rather than holding it in India and then exporting it 2-3 months later. So there was a pull forward of sales that happened. The same pull forward continued in the April to June quarter as well. However, the impact was not as meaningful because Jan to March there was complete fear. April to June there was a relatively lesser fear. But what had happened after that is even more astounding. We will come to the tariffs part later, but let me just say that we can say thanks to FM, the Finance Ministry, the RBI, and the GST Council, and no thanks to Trump. Geopolitics, whether it is with China, whether it is Russia, whether it is the other neighboring countries, or it is all the way between what's happening in the Middle East, or going to the, what's the Donald Trump and the US government is talking about India. The threats are very, very real. They may be temporary, but they are very real, and they may continue to impact our portfolios in the medium term. So what are we doing? Markets are volatile. We did not do much for the, I would say, last 8-9 months. But one thing that we have realized is it is the season of trading. We are now looking at coming up with more trading frequency calls, wherein the time period, the holding period, is typically to 1 to 5 months, rather than thinking about a 1 year or a 3 year or a 5 year horizon, because there are so much uncertainties and the valuations are so high that all the good things have been priced in the stock. We realize it is not the time to be investing for a 1, 3, 5 year period, and rather whatever liquidity or money that we have in hand, the investable surplus that we hold, should be earmarked for trading ideas, where we invest in stocks which can go 10-15% up and can come out of this. If you notice, our last 2-3 years performance is completely opposite of how we have been at Stylus. Our typical holding period on most of the stocks, despite what was happening in 2023 and 2024, our holding period was somewhere around 6 months plus, for I would say 50% of the ideas, and the rest 50% was between 1 to 3 years. However, now that the situation that we are in, we may see a lot of ideas that we are churning in 1 or 2 or even 3 months as well. So that is something that we want to advise to you, that please, as investors, also kind of be aware and be available to monetize this. The reason we want to do this is because we have seen one full year of negative market returns but in that one full year, like the chart on the right will show to you, there were periods where the market was very much down, and there were periods the market was shooting up. So between September to March, we were perfectly spot on with our call, being negative with the market, and kind of staying away from investments, pulling money away from the market, recommending all of you to buy gold, repay your obligations, etc. But what happened after the Operation Sindoor, or the later part where people suddenly started pricing in the tariff as well, the kind of 15% jump that happened in the stock market, this could have been encashed by us, and we apologize for kind of missing that entire sentiment shift. But what we have realized is it's time to course correct. There's no point in thinking of what could have been done had we invested in the month of March, but rather what we can do from here on by making money. The eventual actual thing that you will see in a portfolio is that when the market is falling, we fall in line or slightly somewhere over there, say plus or minus 1%. But when we rise up, when the markets are going up, say the market goes 10% from here, we will try to ensure that the portfolio delivers more than 15% in that same period. That is why we always keep the chart on the right as well. So the last 5 years, the numbers have now drastically changed. Back in say the month of March, the 5-year performance, Nifty 50 was 18%, NSE 500 was 21-22%, our XIRR was close to 40%. Now those things are down. Nifty 500 is 19.5 and we are 35. Still, like I would say that we have delivered in the last 5 years consistently outperforming the market. There is no guarantee that we'll continue to do it, but we will try our real best to be able to consistently deliver this feat. Okay. So yeah, let's talk about tariffs and penalties. So I would like to first circle back to our earlier discussions where I clearly mentioned that tariff is a different word. We call it import duty or customs duty in India. It is largely the same thing. Please do not get confused or think that it's some big problem or things that are happening. Let's first get into what is scenario today. The scenario is and continues to be that pharma and the services sector are not impacted by tariffs yet, whereas the other goods exports that we have from India, anything has its highest ever tariffs. So that now I'll be interchanging between tariff and import duties just to give all of you a feel of the Indian connect. But please bear in mind that the US calls it tariff, we call it customs duty or import duties. Coming back, so over a longer horizon, if you look at it, we are at the highest level of duties on exports from India to US. This is going to lead to a lot of things happening. But as I have mentioned multiple times, if you have missed out on the previous webinars, please do go through it in YouTube as well. We have explained in detail on how tariffs work. What we feel is next 4 more quarters are going to be very volatile. See, we hope that whatever has happened till now, whether it is 25% tariffs, 25% penalty, 50% all inclusive, these numbers are a full stop from here on. There will not be any more increases is what we hope. And if that hope is true, then in the next 3 to 4 quarters, all the volatility will be there in the performance of our companies, of our economy, but all of that will reset. Okay. 3-4 quarters from here, we will be back to status quo. Why do I say so? 2 very simple reasons. All of these duties have to be passed on to the US consumers at the end. Okay, because as India, as our manufacturers here who are supplying to the US, we are not making exceptional profit margins when we export to US. Please understand, when, for example, if you are buying something, say I am a manufacturer in India, my cost of production is 80 rupees and I am selling to an Indian customer at 100 rupees. I make a 25% gross margin. Now, if I export it to US, what happens is, one is I need to add a freight cost. The US to India freight cost needs to be added. And obviously, US is a more developed market. So I try to squeeze some more gross margin out of it. Okay. So manufacturing and supplying in India, my cost is 80 rupees. I sell for 100 rupees. Manufacturing and supplying it to the US consumer at the US port, at the USA, a Walmart, my manufacturing and supply cost is probably going to be 120 rupees. Okay. So there's a 40 rupees increase. So what I do is, on 80, I'm just taking a 20 rupees ka profit. So roughly a gross margin of 20% on sales, and I'm supplying. Now, if I have to do a same 20% gross margin on a US sales, my cost, my price has to be 150, right? If I sell it for 150, I get 20% gross margin, which is what I get in India. Now, what I do is, because the market is superior, I try to sell to them for 170 or 180 rupees. Okay, so there is a incremental, because of, instead of 20% gross margins, I make 30% gross margins, 33%. Right. So this is the incremental advantage that I try to make by exporting to US. I'm talking about any normal manufacturer in India. It's a general, I'm not talking specifically this manufacturer, but as a general, I'm giving you a thought process. Now, if there is 50% import tariff, what happens? So my product, which was selling in US for 180 rupees, if they have to pay 50%, it becomes 270 rupees cost for them, right? So there are 90 rupees additional number is there. Now this 90 rupees, what I will probably do is, because then I am not competitive, right? If it is 270 rupees, then I'm not competitive with the other manufacturers, other suppliers in US. So what I do is, out of the 90 rupees, probably I absorb 20, 30 rupees, some number. Okay, let's not get into the integrities of the number, but just understand this part, that for the time being, I will probably absorb some of my, I'll reduce my gross margin, maybe bring it down to 20%, maybe bring it down to 10% also for time being, just to have my presence in the US market. But once that is settled, once I have threatened or fend off the competition, now that the competition has normalized, I will once again start increase my prices. So what I will do is, I will once again try to go back towards my 30% gross margins. This has played multiple times in multiple countries. The Chinese players do it with us. We will do it with the US. It is all the same. What we have been listening, I mean, if you can talk to any of your friends who are in businesses who have little bit of Chinese, competition angle, they will tell you the same thing, that this has been happening for years between India and China. Now this is going to take place between India and US as well. Okay. Now this is the part of the where I'm explaining to you why US consumers at the end will absorb the tariff, and the Indian manufacturers will once again go back. Maybe like I said, there will be volatility. So maybe the 30% gross margins they were making may drop down to 10% for time being, then come back to 20 soon, then maybe come back to 30 as well. Okay. Now, a lot of this question keeps coming back to me. Why US is doing this? What is there? Why are they saying that we are cheating them? Why they sell to us more to us? Please, I have a very, very different view from what you would read in the news channels or the TV media. All I can tell you is that the US economy needs these tariffs. US debt today is at exceptionally high levels. They do not have the money to serve the interest on those debt. A $4 trillion debt, 2-3%, I mean, right now it is 5% interest rates. They are supposed to spend $200 billion just to pay interest to the bondholders of the government. Now, this $200 billion, how will they cover? So the Donald Trump is a businessman. He knows that he needs to saturate the economy, because a bad economy is bad for business as well. So what he has done is he has decided to put tariffs. Now, if say the Indian government comes and tells us that GST is going to be 40%, customs duty for important critical products is going to be 200%, you will obviously try to overthrow the government, right? So what the US government has decided is create a nice, beautiful narrative. When he talks about all this MAGA, make America great again, he is inherently trying to hide the problems. Okay, so to hide the problems, he needs a new sweeping brush, and the sweeping brush is India. It is India. Earlier it used to be China. For 7-8 years it was China, but now that they can't squeeze China as much, they have targeted eyes on India. So it is just a facade, just a nice, beautiful narrative that they have created, where they are putting the blame on us, Indian economy, that we are trying to squeeze them. But the reality is they need these tariffs to help their own economy, and for this tariff they need to squeeze their customers only. The US consumers who were buying a product, like in the previous example I made, for 180 rupees may have to spend 240, 250 rupees. They may not have to spend entire 270, because something, like I said, gets absorbed by the intermediaries, but they will still have to pay more, 30, 40, I don't know, 20% more, 30% more, some percentage increase will happen to them. Now those people should not feel angry about it. So they will think that it is India's problem. India is set to blame for this, and that is why they are paying this money. Now this is a very nice patriotism angle that Donald Trump has kind of kicked off, and I think it has been working well till now. We will see how it works in the coming months as well. This tariff, and this actually has been covered in detail by this macro expert economist, Mr. Russell Napier. If any of you are really interested to understand what is it, so the word is called financial repression. And if you just search for financial repression in Russell Napier, you will get some very interesting YouTube videos as well as blogs and articles, not just from Russell Napier, but even from people who follow him. They have tried to simplify his, stand on how the US economy is kind of playing out. By the way, despite all of this that's happening, our government has intervened. Let me, kind of give you one food for thought. The GST rationalization has happened in such a speed to kind of counter the US tariffs. Okay, GST has been rationalized, but customs duty has not been cut. So that way, government tries to, deter imports coming in and help manufacturers of India have at least some volumes pick up so that they do not feel the heat. The other part, like I mentioned also, is consumption has been weak for 8 months now. GDP growth has been driven more by timing of exports, etc. Now those things are not enough. The financials, so lot. I mean, like I've discussed it earlier also, the microfinance companies and the NPFCs have seen their worst ever loan growth performance, loan book performance, asset quality issues, etc. So in this benign environment, government has done these booster doses. If you remember in COVID also, there were I think 3 booster actions that the government implemented in 2021. I would say it is a repeat happening in 2025. March 2025, there was a booster dose. June 2025, there was a second booster dose, and September 2025, we have the third booster dose. Same like during COVID. March 2021, when your COVID lockdown was announced, government said that you don't have to pay your EMIs for 3 months. You will get the interest rebate on it. Then in June 2021, they came up with manufacturing support, export incentives, production linked incentives. And then in September 2025, we had the big bang reforms on manufacturing, oil exports, etc. So in this sequence, I kind of find a comparable between how 2021 and 2025 are playing out. And let us hope that these things are able to propel GDP growth for the economy as well. Moving forward. So this question again keeps popping to in all our investor meetings, that what is happening in geopolitics. So I intend to cover this in detail in another session. I mean, if time permits, probably in October itself, just before the Dussehra period. But otherwise, also I'll try to cover it in a separate video where what's really happening in geopolitics. It will be called as the big picture, and where we will discuss all that's happening in a global economy, in the Indian economy, and how you and me as investors have to evolve now to be able to invest in this new landscape. 2025 is going to be a watershed year. We are seeing the way till 23-24 we saw a lot of conflicts: Russia-Ukraine conflict, the Gaza conflict, the Bangladesh conflicts, again the Ukrainian flare-up, US-Mexico conflicts, US-Canada conflict, internal conflicts in Canada. We have seen a lot of things, but what's happening in 2025 is an altogether different ballgame, and it marks a significant change in the investing landscape as well. And I'll just touch on why it is changing the investing landscape, and like I said, the entire discussion is part of a different video. We are currently today looking only at India. And like I said, the investable opportunities are very limited today. But does that mean that we can't invest? Do we really have to do only trading to make returns? Answer is no. If you have a sufficient risk profile, you can invest in other countries. We have in the past recommended investors to invest in the US. In the last 1.5 years, some of our investors we have recommended to invest in China as well. What if we can invest in many other countries? What if we can be aggressive? Why to invest just in US tech? See, the original thesis in investing in US tech was because Companies like the Fangam, Facebook, Alphabet, Google, Microsoft, Netflix, these companies are not there. I mean, these kind of companies are not there anywhere else globally. So it was more of a scarcity reason why we wanted to invest in US tech. But today, in this new landscape, we can invest in other US companies as well. Example, a dairy company in India trades at 30 to 40 times 1 year earnings. In China, a same dairy company trades at 6x 1 year earnings. In US, a similar dairy company trades at 15x, 18x 1 year earnings. So dairy is a very essential defensive product. Like everybody needs milk, butter, cheese. Any product they have, any kind of food taste that they have, they need these three products to survive. And if an investing opportunity arises where you can, because see, India and China today largely are similar in population. We are 140 crore, they are 155, 160 crores, so not much of a difference. Consumption patterns are also quite similar in Asia. All of us are that way dependent on dairy. Maybe some have started moving towards vegan, but generally dairy is a major part of our diet. The growth, etc., is going to be there as well. It is not like in India, the milk growth is going to be 15-20%. We are also probably going at 5-6%. They are also going at 5-6%. Why should you pay 30-40x in an Indian company? You could rather pay 6x in a Chinese company. So this is just one example of the investing landscape changing, and we will discuss this later. Coming back to what quickly is happening on the geopolitics, one major learning for the last, I would say, 3-4 months. In fact, it's not really a learning. This has been the case for centuries. I think it has come to light more clearly in the last few weeks. There is no friend or enemy for an economy or a nation. Every nation thinks about itself. Okay. That is why we call it situationships. Now, in today, this term is a very common word among Gen Zs, but if you think about it, economies and nations have always been on situationships only. Sometimes you're a friend, sometimes you're an enemy. Now, there are some nations that have traditionally been friendly with us. Example, Russia. Right from the independence, even pre-independence days, Russia has supported our freedom fighters, our economy, supporting us. I mean, even most recently in the India-Pakistan standoff, during Operation Sindhu, it was the Russian MiGs that helped us counter the US supplied F-1835 jets to Pakistan. That clearly shows the superior tech transfer, the superior support that Russia has been giving to us. We have been importing Russian oil in heavy quantities for the last 2-3 years. These were at a massive discount to what the OPEC countries were providing to us. It has helped us somewhat, contain our fiscal deficit as well. But that does not mean that we will always work in China. I mean, we will always reciprocate or work in favor of Russia. We may have a preference for Russia, but it will not mean that all our policies will be in Russia's favor. There may be some policies which may be against them. But most of the policies may be in their favor. Same with China. China and India have had a standoff for the last 3.5 years. Multiple escalations and de-escalations have been underway. But does that mean we are at war with them? Well, technically, we have not been on a direct war for the last 26 years. And will we kind of get into a war? You never know. These things can change tomorrow also. But what we know is US is fighting with India and fighting with China. And in this period, if China and India can come together to fend off US, it's a win-win for us. So India as a nation has to think about themselves, not always be, towards a particular nation. It may be towards US, it may be towards China, it may be towards Russia, it may be towards other Southeast Asian countries. It may be against all of them as well. Obviously, being completely against all of them is not to our favor, because at the end we are a globalized economy. But it is the law of the land. US, for example, has been swinging for many years. Sometimes they support Pakistan, sometimes they support India, sometimes they support neither, and sometimes they are like, we control both of them, which is the latest case where they claim that they were instrumental. Maybe they pushed Pakistan to pull back. Maybe Pakistan went to US, didn't work out. Maybe they really pushed India, kind of guys stand off. It could be anything. Nobody knows. But all we can actually tell is that they have been swinging. So, yet, despite them swinging, they are one of our largest trading partners. We have benefited a lot by supplying to them. Uh, will this continue in future? I think it mostly should, because the nature of the US economy is like that they do not have, for example, uh, mobile phone assembly or basic, electronic manufacturing. US does not have labor for that kind of a job work. The government, the Donald Trump may want such manufacturing to pick up, but will that to, translate to actually happening manufacturing and jobs there? Anybody's guess right now, but I feel it is unlikely. So let us just hope that things remain stable. Whatever happens, there is a consistency or a continuity in the relationships. That is all that matters. Things can change. Last week we had very nice photo op between India, Russia, and China. Maybe things change tomorrow. Being one as if you are interested in these kind of politics, and like I said, for the investing landscape, we need to keep decoding what's temporary and what's permanent. For now, it is anybody's guess, but I would probably say that relationship with Russia would likely be permanent, whereas relations with US and China could be temporary for the time being. Okay, we have done a lot of GAN today. This one chart just wanted to show to you how the tariffs are. So you see on the right, the bar has suddenly shot up. We are almost in the highest tariff levels in 100 years. This kind of tells us the fledgling. So if you look at the chart also, how the US-India tariffs, etc. have gone up or gone down. It's been very volatile that way. At some point we are at 5-10% blended, sometimes we are near 2-3%, and now all of a sudden we are at 20-25%. This is quickly on the GST reforms. I don't have much to share on it, but on a general basis, I think what the government has done is wherever 18% was there has largely been either shifted, 28%, largely been shifted to 18. Only few, that is the carbonated beverages, have gone to 40%. There used to be something called a cess that was applicable on many, carbonated beverages, cards, etc. Those cess has been removed. So what happens is the GST credit, etc., kind of that way becomes more transparent. What we feel the government has done is obviously give the booster shot to the economy, but given the focus on compliance that has been there for the last 3.5 years, with more and more formalization of economy at lower interest rates, because see, when the GST rates are higher, there's an incentive. I mean, investors come to me and tell me, take money in cash, or use in some personal name, avoid the GST. I don't want to pay this 18% GST to you. Now, this is what transcends in when the rates seem very high. But what one needs to understand is, once these rates gets formalized, gets kind of lowered structurally, then most of those economy which is going toward the black economy, that gets extinguished. More and more things will become formalized. It will help in credit growth as well. It will help in formalizing the economy. The real GDP that we have may actually start to look much more meaningful. I'm not going to cover that, but when this is largely available in the public domain as well. But any questions specifically on GST, happy to take it. We may not have much time for Q&A today. I plan to cover some stocks myself, but please throw in your questions immediately. We will, if possible, we'll try to address during the call itself. Else, we will try to address them in the via one-to-one mails. Definitely in the newsletter, all those questions will be covered. Okay, this is just quickly on the sectoral performance that's happening. One is, if you notice here clearly how the economies are, like I said earlier, also the investing landscape is changing. Across India, all the indices performance has been negative, while the US, S&P 500, the UK, FTSE are positive. Now, this is a trend which may continue for coming, not just months, but quarters as well. There are some sectoral winners and losers. IT is one sector that we have largely stayed away from. Some of our investors hold a couple of IT sector companies, but those are from a longer term perspective. And I would say, if because it's a 5-year, 10-year holding period, please do not get bothered by these 9, 10, 15% drawdowns in your IT stocks. In the longer period of time, these will get offset. The pharma sector is continuing to do well, although we have started to book some more. In fact, in the coming quarters, we will be booking some more pharma. Coming month, we will be booking some more pharma stocks and probably moving away towards financial services and other sectors, consumption related, which are actually showing better themes. I think one thing I forgot to highlight is, see, I have striked off construction materials as a theme for 2025. What I feel is construction materials may probably be the theme for late 2026 onwards. The industry is still going through a lot of pain, and now that consumption is being revived, the savings will start to kick up in the coming quarters, and preferably by July 2026 onwards, we may once again start to see construction materials doing well. That was one of the reasons why we exited some of our ideas in losses, that for the next 1 year, we may not see material performance from them. So this is just something on NBFCs why we like, because of the paucity of time today, I'll not be covering much on it, but I just wanted to highlight to you that many of these companies like Samman or Shriram Finance or Aditya Birla Capital have actually done well in the last 1 year despite the deteriorating performance. So we are actually starting to look at many of these names, and we'll definitely try to come up with 1 or 2 good ideas in the segment. We've already added 5-star, and we may look at other names as well. Okay, this is something we can skip. Yeah, this is just on the valuations. I think we shared this chart 2-3 months back also, where the valuations were starting to go down. But unfortunately, given the way Q1 results panned out and the market performance being so benign in the last 2.5 months, the valuations continue to be higher. So if you notice the last, area, this section, all the three, whether it is Nifty, mid and small. In fact, you look at the small cap, it's the highest spike in valuations from here to here. And Nifty also, the Nifty mid also has seen a decent spike. So this kind of expensiveness continues to trade in the markets. We will have to, kind of wait out for the numbers to kind of set back and then probably take some investing ideas. Valuations, this is one more chart that shows on the valuations, how valuations continue to trend higher. So we have taken 1 year and 2 year forward P just to show, because many of these companies, the next 1 year may not be as great, but over a 2-year horizon, still the valuations, except probably say, financials, most of the other sectors seem bad. Like I said, consumer staple, the consumer spending industries should definitely, kind of be more. We may look at 1 or 2 more ideas in the next 3-4 months in this space as well, because these are something that remaining very good. And the bottom left chart on healthcare shows you why we are now starting to trim on the healthcare, the pharma stock. Yeah, I think that is largely on what we wanted to touch on valuations. So these are stock related updates. SRF, I think quarterly results were largely in line. See, the stock reached 3,200 rupees, which was actually our target as well, but then it has corrected a bit. We feel that is just tariff tantrum, and couple of months later, once the performance is actually benign, because SRF is a pretty sizable business and very relevant exposure to US, so it is not something that US can live without, and hence we expect SRF can actually continue to perform well even from here on. Same stand for Star Health is the GST thing. The rationalization GST should kind of bode well for them. We are looking at this company in detail. Some of investors, so this is one stock we found that many investors are already holding, even though we have not recommended. So the plan is, probably figure out if this is the right time to buy, and that way the existing investors can also have some kind of an averaging. L&T, very good performance. I understand the stock has not delivered anything for the last, ever since we bought it, but we feel the table is set where it can outperform the market from here on. In fact, the stock price has been flat when the Nifty 50 is down 6%. That also shows the kind of outperformance. See, 0% gain versus 6% loss is still better, right? So that part also I would recommend all of you investors to appreciate. We also, again, Equitas Small Finance is one more stock which we had already exited 1.5 to 2 years ago, but we realized some investors are still holding it. Some have bought it recently as well. We feel this is not the right time to buy. So we will be kind of looking to give you exit also in this space. M&M Finance, have already discussed this. In fact, now with auto sector benefiting from the GST reforms, M&M can continue to do well. Gandhar Oil and Kotak Bank are, again, we have multiple finance names today, so we'll try to, like I mentioned earlier, also that sector we'll be relooking at. Shilpa Medicare, we are deciding to now book some profits. So in the coming days, we'll come up with profit book that way. Suraj Estates, I got a lot of feedback when I shared the report that the stock has not done anything for the last 1.5 2 years, and so just want to give some quick kind of background on how it happened. So around 1.5 years ago, we bought Suraj Estates around 300, 330 rupees, and the stock shot up to 800 in a very quick span of time. And we exited almost half or more than half the quantity, but the rest was still held back, expecting the stock, kind of, if the stock announces some good deals, it may do well. So currently what we see in Suraj Estates is the stock is back to our original entry price, and there is a big 1,200 crore. So this is a 3,000 crore company, and for them a 1,200 crore project is supposed to go online in a couple of months period. And we feel if the traction for this commercial project is very good, then the stock may in fact scale up the earlier peak as well. So that's just on Suraj Estate. I think we have few minutes only left for questions, so happy to take that. All right. This is an interesting question, discussing on how the performance presentation happens. So let me just quickly brief you on how performance presentation is presented in the industry. One major thing is this. In fact, I've already covered this multiple times. I'm not sure if you missed it, but let me once again repeat. So a model portfolio that we have, see, there are stocks in that we bought, say, 3 years ago, that are still part of our portfolio, still recommended to clients. But the price is at a particular level where we do not see the comfort to add it to your portfolio. Okay, that is number one. Number two, there are stocks that you may already be holding, which will lead to a differential performance between our portfolio and your portfolio. Number three, there is a timing difference. Okay, you may buy a stock, say we recommended a stock at a particular date. Say, let's take the example of Suraj Estate itself. So we are holding some quantity from last year. We have bought some quantity this year again, right? So the XIRR for Suraj Estates will actually look very bad for a model portfolio, and it will be in line with what it's looking for your portfolio if you are an old investor. But if you are a new investor and you are buying Suraj Estates today, your XIR will be different. So there are multiple such things happen. Now you will tell me, why does it matter to me then, right? to be very frank, even I have thought a lot about how I can present performance to you on a regular basis, wherein you know how things are happening. But the fact of the matter is, when we have a model portfolio where there are say 30 stocks, and your portfolio where there are say 20, 25, or even 30, 35 stocks, but these are two not similar. Okay, so this is one circle and this is another circle. Now the portfolio is like this. Okay, so there are some stocks in the middle part, right? This middle part where we call it the Venn diagram. I'm not. It's called the Venn diagram something. So where there are some stocks which are in the model portfolio as well as your portfolio, but there are some stocks which are only in yours and some stock only in the model portfolio. Because of this, there will always be a disparity in the performance. So that is why what we do is when we give you the annual performance report, that time we show your portfolio's performance over the last 1 year as well as the history of your portfolio with us. So that way, what I will recommend to you is this model portfolio performance we are just showing to say that how things are happening. It is not to be construed as this is how your portfolio will work. Like I've always said, your portfolio performance as well as the model portfolio performance will massively differ. And this is true for everything other than a mutual fund. Okay. If you are investing in a PMS, if you're investing in some other advisor, if you're investing in AIF or some recommendation, other tools, etc., that we have, RoboCab, etc., all of them, you will have the same issue. Only in a mutual funds case, what happens is your amount is priced as an NAV. So there is a basket of stocks, say Nippon ka small cap fund. Now Nippon small cap fund already has 70,000 crore rupees invested. This 70,000 crore rupees is divided into 7,000 crore units, and the cost of one unit is 10 rupees. So today, if you are doing a SIP, you are paying the same 10 rupee. Or if you're buying the units from the market by your broker, you are paying same 10 rupees and getting one piece of that, the entire portfolio. The portfolio as is, you get a stake in it. But that can only be possible for a mutual fund because it is a pooled investment vehicle. In the case of direct investing, in the case of PMS, AIF, or any other direct investing pool, this kind of NAV based unit purchase is not possible, and hence there will always be a performance difference. So you may come across some PMS, some fund manager saying, or even like me, I am saying 35% in the last 5 years. Okay, I will be completely true to you. In our investors, so we have some investors who are more than 5 year plus, right? None of them is exact 35%. Number one. Number two, some investors, the 5-year IRR is just 28%. One investor, the 5-year XIRR is 48%. Now you may ask me how. I will get, so we have done this analysis as well. In fact, this is what we address in your annual report also, the annual performance report that we share with you. We try to address this part. So for example, the analyst, the investor who had a 48%, I'll just give you detail like what he did. So he pulled out money in 2021. So his portfolio used to be some 1.1 CR in 2021. He pulled out 50 lakh rupees to buy a car, buy a home. Okay, he took 50, I think one CR ka loan he took, and 50 lakhs ka down payment he did by selling his shares. Okay. Fortunately, from November 2021 till Feb 2023, 1.5 years, market did not go anywhere. Our portfolio return was some 3-4% in that period. Before that, the portfolio was 40%. In that 1 year, 3 months period, 1 year, 5 months period, the portfolio gave just 5-6%. Okay. He got a big bonus. So what he did from March 20, I think, from Jan 2023, he started dumping money in the market. Every month he would call me, Himanshu, I have 5 lakh rupees, I have 6 lakh rupees, I want to put in the market. Okay. In a span of 10, 11 months of 2023, he invested 25 lakh rupees more. So his portfolio had come down to 60 lakhs. From 1.1 it had come down to 60 lakhs. From 60 lakhs, it was at 65 lakhs, some 8-9% in 1.5 year period. From 68 lakhs, he invested another 25, but today's portfolio is 1.8 CR. Why this happened is, again, in 2023, when he was investing, market was very buoyant. The ideas that where we gave 5, which we bought in 2022, thinking it will deliver in 3-4 years, in 1 year it gave that double. So he was lucky that way, and he was able to outperform. So I get 35, he made 48. It's a true story. There is the other investor, like I said, he is at 28%. He had some good holding in a company called BPCL, Bharat Petroleum. He is an employee of the company. He has ESOPs in that company, and he decided that he wants to hold those ESOPs. Okay, he listened to us. He sold some of the ESOPs, but he was like, "Nahi, I have 6,000 shares. I will sell maximum 3,000 shares." And then the 3,000 around 1.5 years ago became double again. The bonus happened. It became 6,000. There was a period where BPCL also performed well. So he somehow escaped through that allocation because his portfolio 25% is BPCL. Despite that drag and whatever happened, still 28 is still very good, right, for a 5-year performance. So that is why there will be unlimited cases. Every individual investor's portfolio performance shall not match with our performance. Our XIRR is a general idea for you how our ideas are performing. So if you ask me how should I look at a model portfolio performance, I will say is you just have to look at it that am I able to, as a model portfolio, am I able to outperform the market or not? Okay, because if I'm able to outperform the market consistently as a model portfolio, there is a very high possibility that I can replicate that for your individual portfolios as well. I hope this question answers your question. If you are still have queries, happy to discuss this further offline. We have just less than 2 minutes left. I'll quickly cover. Okay, thank you so much. Thank you for the appreciation messages, guys. Any idea on long term? Like I said, we are not seeing any long term ideas, so we are not recommending anything. Query on Yes Bank. I'll just quickly cover in a few seconds. Yes Bank. So Yes Bank is going through a massive transformation where it is being acquired by a Japanese company called Sumitomo. Sumitomo in Japan is a very, very sought after. It's again a big family. I mean, probably I would say somewhere like Tata Birla Ambani's of India. They have Sumitomo, Mitsubishi, and a couple of other families there in the Japan and region. So it's a good change. The bank, however, is struggling on only one area. So I would say overall there are 5 triggers in a bank. 4 are doing well. Just one place they are not working well is the retail book. So what they have done is a lot of retail loans that they have given. The yield on that is not as good, and they are spending a lot on customer acquisition. Like I am a user of Yes Bank. They gave me so many benefits. Every quarter they give me like some vouchers of Taj, etc. What 5,000 rupees on a savings account. So that kind of splurge they are doing to retain customers at Yes Bank. So I am not an investor of Yes Bank today, but I am a consumer of Yes Bank, and I'll tell you something that it is really well. Like I said, just every quarter I'm getting some vouchers, etc. of them.
The webinar has ended. Thank you for joining. Bye.